Hi, foundation students. This is Manel this side. And this today I will be continuing the LLP part 2, LLP Act 2008 part 2. RTP discussion will continue. In RTP, this question they had asked in the RTP question. This was asked in the RTP. So let's discuss now. So, the maintenance of books of accounts. The question is about the maintenance of books of accounts and other records and audit under section 34 LLP. This will come for 5 marks if it comes. So you guys have to study this properly. So, what are the books and stuff they have to maintain? They have to maintain the books of accounts, proper books of accounts. It may be prescribed and it may be in cash basis or accrual basis, and it should be according to the Balanced system of accounting, and should be kept at the registered office. It should be kept and maintained at the registered office. Okay. Next, next point is every LLP should, within a period of 6 months from the end of each financial year, they have to prepare a statement of account and solvency. They have to prepare an account on. They have to prepare statement of account and solvency. So every LLP within a period of 6 months from the end of the financial year, they have to prepare a statement of account and solvency for the said financial year. Then as the last day of the said financial year. So what this means is the LLP should prepare a statement of account and solvency for the said financial year as the last day of the financial year within a period of 6 months. And this statement of solvency, account and solvency should be signed by the designated partners, of the LLP. Next point is this statement of account and solvency which is prepared should be filed with the registrar every year within prescribed time. This prescribed time is within 30 days. This prescribed time is within 30 days from the end of the financial year, from the end of the 6 months of the end. Within 6 months, this you will file now. This within a period of 6 months from the end of the financial year, statement of account and solvency which you prepare. From the end of the 6 months, within 30 days, you have to file this statement of account and solvency with the registrar every year in such form and manner, accompanied by such fees as may be prescribed. Then these accounts of the LLP shall be subjected to audit in accordance as per the rules. Then next, this point you should read properly, and this point also should read properly because these are new points, newly added, updated, amended. So what does it say? LLP, if it fails to comply with the provisions of subsection 3. What is subsection 3? Subsection 3 was it should file within a prescribed time the statement of account and solvency with the registrar every year. If it fails to file with the registrar, the LLP and its designated partners, both the LLP and the designated partners will be liable to a penalty of 100 rupees for each day for continuing failure. Then subject to maximum of 1 lakh for LLP. For designated partners, it's 50,000. So what is it? So LLP, if it fails to file the statement of account and solvency with the registrar, in such a case, LLP is subject to LLP and designated partner subject to a penalty of 100 rupees per day, and on continuing failure, and maximum 1 lakh for LLP and 50,000 for designated partners. This you should remember. Next point is any limited liability partnership which fails to comply with the provisions of subsection 1, subsection 2, and subsection 4. Such LLP shall be punishable with a fine. It shall be punishable with a fine which shall not be less than 25,000 rupees, but which may extend to 5 lakh rupees. This is LLP, 25,000 and which may extend to 5 lakh. And every designated partners, the partners will be punishable with a fine which will not be less than 10,000, which may extend to 1 lakh. For which cases? For subsection 1, 2, and 4. 4 is for audit if they don't get the books of accounts audited. 2, if they don't prepare the statement of account solvency within 6 months from the end of each financial year. And if they do not maintain the proper books of accounts, the default, if they violate these sections, then in such a case, the LLP is subject to a penalty of 25,000 to 5 lakhs, and every designated partner will be subject to a fine of 10,000, but is extend to 1 lakh. Next, coming to this central government may consultation with NAFRA. This is related to NAFRA, National Financial Reporting Authority, Section 132 of the Companies Act. This you can study simply. I don't know if the chance of coming for exams this one, but you just study one. So what does it say? Central government with consultation with the National Financial Accounting Authority (NFRA) will form prescribe such standards. So in consultation with the NFRA, central government will prescribe standards on accounting, standards of auditing, standards of accounting standards. Standards of auditing is standards on auditing, like you still don't have it when you come to inter and final. There will be standards on auditing, and as well as accounting standards should be applicable to companies. Okay, as recommended by the Institute of Chartered Accountants of India under Section 3 of the 1949 Act. Then coming to annual return, this is very important. Annual return is very important. I will make a small video of this.